Why secure notes are considered as secure. A company's secured note, often referred to as a secured bond or secured debt, is a type of financial instrument that a company issues to raise capital. It just works like a company debt, meaning the company borrows money from investors and promises to repay the principal amount along with interest over a specified period. What distinguishes a secured note from an unsecured note, or debenture, is that it is backed by specific assets or collateral owned by the company. These assets serve as a form of security or guarantee for the bondholders in case the company defaults on its payments. There are several key characteristics of a company's secured note. One of the important keys is the collateral, which guarantees the secureness of the debt. The issuer of the bond pledges specific assets, such as real estate, equipment, inventory, or other tangible assets, as collateral. If the company defaults on the bond, bondholders have a legal claim to these assets to recover their investment. Similar to other debts, the issuer of the secure notes will pay periodic interest to bondholders, typically semi-annually or annually, based on a fixed or variable interest rate specified in the bond agreement. No matter whether the notes are short-term, which lasts a few months, or long-term, which may take several years, on the maturity date, the issuer is obligated to repay the principal amount to bondholders. In the event of bankruptcy or liquidation, secured bondholders have a higher claim on the specified collateral than unsecured bondholders and other general creditors. Since secured notes are considered less risky for investors compared to unsecured notes. As a result, they often have lower interest rates than unsecured debt. One real-world example is the issuance of secured notes by Ford Motor Company. Ford has issued various secured bonds backed by the assets of the company, such as its automotive inventory, equipment, and accounts receivable. These bonds are typically issued to raise capital for various purposes, including financing operations, research and development, and debt refinancing. Ford issued secured bonds backed by its automotive receivables in the past. These bonds are secured by a pool of auto loans and leases. The cash flow generated from these assets is used to repay the bondholders. This is a common practice in the automotive industry. Thanks for watching. If you liked the video, please hit the like button or subscribe button for more interesting topics.